Wei, we certainly saw quite a bit of risk-on come through in the markets yesterday on hopes for that Moderna vaccine. Today, it's a little bit more of a risk-off day. Of course, the Chinese data might have something to do with that. When you look at the appetite that investors have had for risk assets, it looks from your ETP flows that there's been a big favouring for fixed income in June. Has that mainly been in credit on the assumption that central bank support is going to be around for a while?
Absolutely. June was a record month for credit ETP flows, which makes the ETP flow globally also a record month in June. And this is largely coming off the back of central bank support. So if you think about the Fed likely going to stay at zero or close to zero for an extended period of time, 3 years or maybe even longer, that is really taking away income. Think about it. And that really is intensifying this scramble for anything with income. And that is very much supporting credit, which is why we continue to keep our overweight in credit, including investment grade and also including high yield, because we expect the search for income to continue to intensify and here to stay.
Yeah, and what's interesting as well, if you look at the stock market in the US, so we had a few weeks of NASDAQ outperformance of the stay-at-home trade, some showing worries that that trade was perhaps getting extended. But this week, the NASDAQ's actually underperformed. It's down so far this week, while the S&P 500 has posted gains. Some say, look, what this shows is that investors are always going to find something to buy in the US stock market in any economic circumstance, convinced of Fed large S. Is that the interpretation among a lot of investors that you speak to?
Well, we see NASDAQ and tech-related names giving back a little bit in a week where there has been vaccine development or positive news. This is not surprising because if you think about big tech names, they're really the stay-at-home investments, and they have outperformed when everybody is working from home, staying at home. And if that prospect were to change, we could see a bit of a rotation. But we do continue to believe that some of the structural trends, for example, digitalization, technology adoption is getting accelerated by events this year. So tech as a secular trade, secular investment theme is we continue to favor that. However, should news around kind of vaccine development really continue to come through with further substance and evidence, then this cyclical rotation that we have started seeing coming through could persist for a while. So as an example of that, some of the value-oriented exposures started turning around, and we also have seen flows following them as well in June and also coming into July.
Yeah, that's interesting what you say about value inflows picking back up. Is this a trend that you've seen globally across equities, or has it been more concentrated in certain geographies?
I would say European equity block as a value peak in comparison with the composition of the US equity market. We started to see flows coming through in a big way. So just to contextualize that, year to date, we're still out $30 billion of outflows from ETFs and active exposures, giving exposure to European equities. But the trend of turning around from significant outflow and significant underweight into tentative buying in June and coming into July into European equities, that is really unmistakable. And we favor European equities at this juncture because the block is further ahead in the pandemic curve, seems to have a better grasp of containment, and they were more prudent both in lockdown and now also in reopening, not to mention the recovery funds. We're getting some more details over the next couple of days, hopefully further supporting that. And all of that very much positions European equities favorably, especially in comparison with US equities that have done very well so far already. So we have upgraded European equities, and we have moderated our view on US equities.